Let me ask you something uncomfortable. If you're between 25 and 35 right now, what are you doing with your money? Because here's what nobody tells you when you're young and broke, and just trying to get through the month. The decade you are living in right now is the most financially powerful decade of your entire life. Not your 40s, not your 50s, not when you finally have enough money to invest. Right now. This window, these 10 years. And the terrifying part, most people waste it completely and don't realize it until it's already gone. Stay with me, because by the end of this video, you're going to see your age differently. You're going to see your money differently. And if you take just one action, after watching this, it could literally be worth hundreds of thousands of dollars to your future self. Section 1. What is compounding and why most people misunderstand? If you've probably heard the word compounding before. Maybe in school. Maybe from a finance maybe your dad mentioned it once and you nodded like you understood. But here's the problem. Most people hear the word compounding and think it just means interest on interest. They think it's a math concept, a spreadsheet thing, something boring. It's not. Compounding is a wealth multiplier, and like every multiplier, it needs two things to work. A number to multiply, and time. The bigger the time, the bigger the result. That's it. That's the whole secret. Here's a real example. Let's say you invest just $300 a month, starting at age 25. You earn an average of 10% annually, which is roughly what the S&P 500 has returned historically over long periods. By age 35, just 10 years later, you have around $57,000. Doesn't sound life-changing yet, right? Here's where it gets interesting. You then stop contributing completely. You don't add another single dollar. You just let that $57,000 sit and grow. By age 65, that $57,000 becomes over $990,000. You contributed only $36,000 of your own money. Compounding did the rest. Nearly $1 million, from 10 years of $300 a month, started at age 25. Now here's the painful comparison. Someone else waits. They're busy in their 20s. They'll start when things settle down. They begin investing at age 35. Same $300 a month. Same 10% return. They invest all the way to age 65. That's 30 years of contributions. 3 times longer. They end up with about $678,000. They invested more money 4 more years and still ended up with LESS. That is the brutal math of compounding. It doesn't reward effort. It rewards early starts. Section 2. Why 25 to 35 is the only window that truly matters. Now you might be wondering, why specifically 25 to 35? Why not 22 30? Why not 32 40? Great question. Here's the reality. Before age 25, most people are still in school, starting careers, or barely making enough to cover rent. The income simply isn't there for most people. And that's okay, because the window hasn't opened yet. You have Chimi. After age 35, compounding still works, but it loses its most powerful ingredient, maximum time. The returns become smaller relative to what you could have built. You're essentially playing catch-up for the rest of your financial life. But between 25 and 35, something special happens. You have just enough income to start investing something meaningful, even if it's small. You have just enough time, minus 30 to 40 years before retirement, for compounding to perform its greatest magic. And you have just enough financial freedom before mortgages, kids, college tuitions, and life responsibilities eat your cash flow alive. This is the window. This is the sweet spot. Think of it like planting a tree. You can plant a tree at any age, but if you plant it at 25, by the time you're 65, you have a giant, strong, shade-giving tree worth sitting under. If you plant it at 45, you get a decent tree, but it will never be what the first one was. The soil is the same. The seed is the same. Only the time is different, and time, once gone, never comes back. Section 3. The real enemies of compounding in your 20s and 30s. So if compounding is this powerful, why don't more people use it? Why are millions of people in their 40s and 50s starting from zero? Because there are real enemies attacking your compounding window right now, and most of them feel completely normal. Enemy number 1. Lifestyle inflation. You get a raise. You get a better job, and instead of investing the difference, you upgrade your car, your apartment, your wardrobe. Your income goes up. Your savings stay at zero. This is lifestyle inflation, and it is the number 1 killer of compounding potential in your 20s and 30s. Enemy number 2. Debt that drains your cash flow. Credit card debt at 20% interest doesn't just cost you money, it steals your compounding potential. Every dollar you're paying in interest is a dollar that could have been growing at 10% annually for the next 30 years. High-interest debt is like a hole in the bottom of your wealth bucket. You can pour water in all day, but it never fills up. Enemy number 3. The I'll start later. Mine said this is the most dangerous enemy because it feels completely reasonable. I'll invest when I make more money. I'll start once I pay off my loans. I'll begin after the wedding, after the kids, after the move. Later never comes. Or Juana Duis, the math has already punished you for the delay. Enemy number 4. Not knowing where to start. Some people aren't lazy. They're just lost. The financial world is full of complicated terms, conflicting advice, and products designed to confuse you. So they do nothing, and nothing, compounded over 10 years, equals nothing. We'll fix that in a moment. Section 4. Exactly what to do right now, okay? Enough of the scary math. Let's talk about action. Because information without action is just entertainment. Here is a simple, clear roadmap for anyone between 25 and 35 who wants to use this window properly. Step 1. Kill your high-interest debt first. If you have credit card debt above 10% interest, that is your first investment. Pay it off aggressively. You will not out-invest 20% interest. Get rid of it. Then redirect that cash into building wealth. Step 2. Build a small emergency fund before you. Invest a single dollar in the market. Have 3 months of expenses saved in a simple savings account. This is your financial seatbelt. Without it, one bad month forces you to pull money out of investments at the worst possible time. Step 3. Start investing. Even small amounts. Open an investment account. If your employer offers a retirement plan with any employer match, contribute at minimum enough to get the full match. That is an immediate 50% to 100% return on your money. Nothing in the market beats that. If no employer plan is available, open an individual retirement account or a simple brokerage account. Start with whatever you can. $50 a month, $100 a month. The amount matters less than the habit. Step 4. Invest in simple, diversified index funds. You don't need to pick stocks. You don't need to follow the market every day. Simply invest in a low-cost index fund that tracks the broad market. Keep your fees low. Stay consistent. Don't panic when markets drop because they will drop and they will recover. Step 5. Increase your investment rate every year. Every time you get a raise, increase your monthly investment amount before you increase your lifestyle. If you get a $500 raise, put $300 into investments and enjoy $200. That one discipline, repeated over 10 years, transforms your financial future. Step 6. Protect your compounding. Do not touch it. The biggest mistake people make is pulling money out of investments for non-emergencies. A vacation, a new car, a business idea they haven't researched. Your investment account is not a savings account. It's a compounding machine. Every time you take money out, you lose not just that amount, but every dollar it would have grown into over the next 20 years. Section 5. The mindset shift that changes everything. Here's the final thing I want to leave you with. And it's not a number or a strategy. It's a mindset. Most people in their 20s and 30s think of investing as something rich people do, something you do after you've made it, something for later. Flip that completely. Investing is how you become someone who has made it. It's not the reward at the end of the journey. It's the vehicle for the journey itself. Every dollar you invest today is a future employee working for you 24 hours a day, 7 days a week, compounding silently while you sleep, while you work, while you live your life. The rich don't have more hours in the day than you. They just put their money to work earlier and let time do the heavy lifting. You are sitting in the most powerful financial window of your life right now. The question is not whether compounding works. It does. The math is irrefutable. The only question is whether you will decide to use it. If this video opened your eyes, share it with someone between 25 and 35 who needs to hear this. You might literally change their financial life. Drop a comment below. What's the one step you're going to take this week? And if you want more content on building real wealth, subscribe. Because we're just getting started. Your future self is watching you make this decision right now. Make the right one.